The growing size of the U.S. national debt is quietly shaping why prices across the American economy rarely move backward. As federal debt climbs beyond historic levels, economic policy has shifted toward protecting growth and stability, even if that means accepting permanently higher prices. According to the U.S. Treasury, federal debt now exceeds the size of the entire U.S. economy, increasing pressure on policymakers to avoid economic slowdowns that could make debt harder to manage. One reason prices rarely fall is that deflation, widespread price declines, would increase the real burden of debt. When prices drop, the dollar becomes more valuable, making existing government debt more expensive to repay in real terms. Economists warned that falling prices would strain federal finances, raise borrowing costs, and risk destabilizing financial markets that rely on predictable inflation. As a result, U.S. monetary policy strongly favors moderate inflation over price declines. The Federal Reserve plays a central role in this dynamic. While the Fed raises or lowers interest rates to control inflation, it does not attempt to push prices back to earlier levels. Its stated goal is price stability, not cheaper goods. Once prices rise, policy focuses on slowing future increases rather than reversing past ones, a strategy that supports debt sustainability and avoids shocks to employment and financial systems. Corporate pricing behavior reinforces this trend. Many large U.S. companies operate with long-term contracts, fixed labor costs, and shareholder expectations that depend on stable or rising revenue. When inflation pushes prices higher, businesses adjust to the new level rather than retreating, especially in sectors like housing, healthcare, insurance, and utilities. Even when input costs ease, price reductions are often limited or delayed. Consumer behavior also matters. Despite higher prices, American spending has remained resilient, supported by credit use, wage growth, and government programs. As long as demand holds, companies face little pressure to lower prices. This allows elevated price levels to persist even as inflation data shows improvement. Together, rising national debt, inflation-focused policy, corporate pricing structures, and sustained consumer demand explain why prices in the United States tend to rise in steps but rarely fall back. For households, this means the cost of living challenge is less about temporary inflation spikes and more about adapting to a higher, permanent price baseline.